All right. Okay. All right. So, morning, everyone. Just a little music to wake us all up. Hello, everyone. I'm Lizette Gabriel, and I work as a librarian in the Business and Economics Department here at the Los Angeles Public Library. Welcome to today's presentation called Tax Essentials for Entrepreneurs, Part 1, Business Structure, Choosing Smart from the Start. Launching a business is exhilarating, yet long-term success relies on maintaining compliance, making smart tax decisions, and building financial confidence. This two-part workshop series, a collaboration with the Small Business Development Center, PCR, and I believe Los Angeles regional office, is tailored for entrepreneurs, freelancers, and small business owners eager to establish a solid foundation and manage their taxes effectively throughout the year. If you would like to send us your questions, please log into your YouTube account so that way our presenter can then see the questions throughout the presentation. I believe Dr. Chevy will be answering the questions, if not throughout the presentation, then at the end of the presentation. So also another thing to keep in mind, if you're not able to see the presentation at the beginning, or if for some reason you need to step away, this presentation is being recorded, and once the presentation ends, it will be uploaded to our YouTube, the library's YouTube channel. All right. So now I am going to pass over the presentation to Dr. Chevy. Okay. And I leave it up to you, Dr. Chevy.
Hey, good morning, everybody. Thank you. Thank you for actually joining us today. You know, it's 11 o'clock in the morning today. The sky is beautiful. You know, we got a great day out there. It's should be about 75 degrees, but guess what? It is a beautiful day to actually learn about your business structure. Ultimately, and I'll give you a quick background story about a client that I just had this morning. She's in a great position in the sense that she's paying too much in taxes. Now, why is that relevant? Well, because there's a lot of strategies out there that we can actually implement to reduce the tax liability. The biggest vehicle that you will have to allow that is in your fingertips, the small business. The small business. Try to understand a couple of things. When it actually comes time for the IRS tax codes, it wasn't built for you, the individual. It was built around businesses. So therefore, there was a lot of things that we can actually do to maximize and optimize on profitability, but even beyond that, to go ahead and then showcase, or should I say, build, quote unquote, generational wealth. All right, guys, my name is Dr. Jorge Chavarin. I'm actually one of the main presenters here at PCR, Pacific Coast Region Small Business Center. And so I'd like to say welcome to you. You know, I actually say welcome to, quote unquote, the LA Library for allowing us to do this. Joining us today is Ms. China Naylor, who is the Assistant Director for PCR. Of course, you know, Lizette Gabriel, who is the Los Angeles Library Business and Economics extraordinaire, and then myself. So a little bit of background about myself, and then I'll actually caveat into what PCR actually does. So I'm actually retired. I'm a retired United States Marine. I did 24 years of active service, and if we actually have any veterans out there, hey, how we doing? Okay, stay on the fight. Guess what? Entrepreneurship, believe it or not, if you served, you're in a good place because you've actually experienced a lot of stress. So other than being a quote unquote United States Marine, I actually utilized all my educational benefits to get educated, quote unquote. I got an MBA degree. I got a doctorate degree in 2011, 2012, if I remember correctly. I started a professorship. I quickly rose up the ranks. I became a department chair. And then one thing led to another. I actually found myself at a quote unquote crossroads. The university was actually bought out by a larger university. They did a mergers and acquisition. And if you're familiar with that, I basically got my walking papers. They did away with my position. So now I was in a position to say, okay, put your money where your mouth is. You actually teach about business. You teach about leadership, but can you run a successful business? Well, I'm here to tell you that I started in 2019 and I've actually been at it since then. And I've actually gone from the quote unquote profitability state to a sustainable state, right? What does that mean exactly? It means that if I walk away from my small business, my business is still making money. That's literally what it means. Now, to do that, it's a lot of heartache. It's a lot of late nights, a lot of early mornings. a lot of back end work, a lot of commitment, a lot of missing family functions, because that's a journey that you're on. Okay. It is not as easy as it sounds, because you never know where that next client is going to be coming from. So, having said all that, what do we do here? Or what does the SBDCs do? Who are we? Well, we're a national program. We got over 1,000 locations throughout the United States. And what we do is we try to stimulate economic growth. Okay, we try to do that. How? One client at a time is how. We quote unquote are partnered with the SBA, but please keep in mind, excuse me, the SBDC is not the SBA. Okay, we're not the SBA. So, two distinct organizations. But at the same token, we do understand a lot of their processes. Now, what we do is we provide a host of business consulting one-on-ones. We do training and webinars. We do resources. We try to find you and locate you, or try to partner you with something that's going to help you out. So, for example, if you said, hey, Chevy, I need some assistance trying to access capital, no problem. Let's talk. Let's see how the business is actually doing. And then we're going to determine to see if you're going to be a good fit for a quote unquote lending institution. Now, please keep in mind that all lending institutions are different. Okay. Yes, they share commonalities, but at the same token, some are going to have different criteria above others. So, long story short is we can help you actually start a business. We can help you grow a business, and we can help you sustain your business. And guess what? It's free, no cost, no catch to you. Okay, these services are actually provided because of the grants that we get from the SBA, and in some cases, some local entities provide us some funding. So we're able to provide this information to you, these consulting sessions to you, free of cost. Okay, now, what kind of services can we provide? Well, we can provide legal, as in we can help you set up your company, whether you're going to be an LLC, a corporation, a DBA, limited liability partnership, multi-member LLC, a general partnership. The list just goes on and on and on. We can help you with business planning. We can help you with marketing, social media, procurement. My specialty is finance and accounting, so I can help you in those regards, basically getting your books in order and ensuring that the numbers that the quote-unquote business is actually true and accurate. So whatever it is that you're inputting into some kind of a software and or your bookkeeper, the information is quote unquote true and accurate. Now, we also provide information, or should I say guidance, on restaurants and the construction industry. Along the way, I will be providing you with a lot of tips. Why? Because we're in tax season, that's why. And as a small business owner, you want to know if in fact, or how in fact, you can actually save on taxes. Now, we do have a host of quote unquote sessions that we provide. The Financial Fitness Series is something that I stood up a couple of years ago, thanks to Colette Moore, the director. She allowed me a lot of latitude to create something that was very unique for the organization. And since then, I've been able to expand on it. We started with one class and we expanded to 4. And now I'm doing about 8. So there is a lot of classes that we actually provide. All you got to do is visit us. If you're an SBDC client already, and it doesn't matter which one, as long as you're in the LA network, you have access to these classes, to these webinars. All you got to do is go on the website, smallbiz.org, if I remember, lasmallbiz.org, if I remember correctly, and it'll showcase what classes are coming up, and you can attend them for free. Now, having said all that, here is the first quote-unquote poll question that I have for you. If you can, please do me a favor. Put it in the chat. Let me know. Have you filed your taxes already? I'm going to give you guys about 30 seconds to go ahead and answer that. I kind of want to know where we're at. Kind of want to get a feel for the people that are participating in today's webinar. China, you still there? China?
Can you hear me?
Yeah. Let me know what's in the chat because I can't see it.
Okay. Yes. So we have a few no's and we have some 3s. No yeses, though.
Okay. Well, that's a good thing.
Mm-hmm.
I'm going to go ahead and just ask one more thing of you. In the chat, if you have a small business already, if you're existent, can you please let me know what kind of a business structure you currently have? It'll give me an idea of I need to go ahead and revamp the presentation on the fly, which I've done always. I just want to make sure that it's more in tune and accurate for what the individuals that are participating in today's webinar is. China, can you let me know again, please?
Yes. So start LLC, sole props. We have one that just filed for a corporation this past weekend.
So again, along the way, I'm going to provide you with a lot of quote unquote tips. The corporation one, well, there's a couple of reasons. We're going to discuss exactly why we actually set those up. I'm just curious as to why you set it up. So that's a conversation we can have at another given point in time, because sometimes it has to be a professional corporation that the state of California actually says, hey, by the way, you must be a professional corporation. And or sometimes it's just, I want to try to raise capital. But we're going to cover that here shortly, okay? So again, kind of gave you an overview of my background already. I just go by Dr. C, Dr. Chevy, or just Chevy. It just really depends on the arena that I'm in. If I go back to the quote unquote university setting, clearly they're going to go ahead and address you by my title. And I do that often because I do a lot of speaking engagements with former professors that quote unquote used to work for me. They always invite me back to the classroom to speak. And so I kind of enjoy that. But again, it just really depends on where we're at. But today's session, you could just call me Chevy. So if you have a question, this is what I will ask of you. At the end of the presentation, I always open up the forum. So I'll go through the presentation. If you have questions, please hold them till the end. Now, it's something that's really, really burning. Put it in the chat. I'm going to go ahead and let our assistant director decipher if I should answer that question on the spot right there, because it might be something that it just needs to be addressed at that given point in time. So disclaimers, please understand that the information that I'm providing is literally general information only, okay? It doesn't constitute any legal, tax, and or financial advice. However, if there's something that I say that actually quote unquote resonates with you, please have that conversation with your CPA. I speak from the general terms. I do have my own small practice. I do tax strategies on the side. That's where my main bread and butter actually comes from. So having said that, okay, some of the information that I do provide is true and accurate, but I don't know your scenario. I don't know if it's going to be applicable to you. So in that regard, please have those conversations with your CPAs to see how it's going to impact you. Now, again, already talked about this. There's a lot of classes that we actually have. If you visit us on LA Biz, what is it? Is it lasmallbiz.org? China, do you remember? Put it in the chat, the one for LA Network. But if you're with PCR, you are a client of PCR, you can just go to our website and take a look at all the workshops that we provide. And again, they're free of cost. Join us, okay? Join us. So what are we going to be talking about today? What are we going to learn about today? Well, we're going to understand some of the key types of business structures. In the chat, we've mentioned already that there's LLCs, there's sole props, there's corporations. Well, we're going to discuss all of those and much, much more. We are going to compare how they actually impact taxes, okay, how you legally pay yourself in some scenarios. And then we're going to learn how to actually pick what may be the best, quote unquote, business structure for you. Now, if you are in the preliminary stages, as in you're just starting out, you know, this is something to keep in the back of your mind. This is something that if in the near future you start crossing thresholds that you might really, really want to consider. Ultimately, okay, it will impact you personally, not just the business. So, any questions thus far? Anything in the chat?
Nope, we're good.
Outstanding. So let's move forward then. So, an overview. Okay. These are the structures that we're going to be discussing today. Okay. We're going to be talking about sole proprietorships. We're going to be talking about DBAs. We're going to be talking about partnerships, both general and limited. We're going to be talking about limited liability companies. We're going to be talking about C corporations. Now, the big question, well, Chevy, I'm an S corporation. Why aren't you going to talk about that? Because it's not a business entity, guys. S corporation is a tax strategy. Okay, and I'm going to show you the power of the S corporation later on in the presentation. Okay, so I'm going to be focusing on the 4 that I have up here, and actually it's not even 4, it's more like 6. But you'll start to understand here quickly how it really does impact you individually as far as your taxes are concerned. So when we take a look at for example, at the sole proprietorship of the DBA, what we can see here as an overview is that it can be just one individual that owns it. I'm going to talk about exactly who that might be. But liability, which is one of the key portions whereby when we open up a small business, we kind of want to put some barriers in front of us, hoping that the business never gets sued, because if it does get sued and there is no liability protection, you're going to be sued as well, right? So we're going to talk about that a little bit, and then I'm really going to dig into the taxes, okay? We're going to talk about business deductions. What the IRS is considered a business deduction. I'm going to provide you some examples. I'm going to provide you with, quote unquote, a side-by-side comparison of an LLC versus an S corporation versus a C corporation. It's lengthy, guys. It's lengthy. And guess what? We only have an hour and a half to cover all this stuff. Normally, I present for 2 hours, and normally when I was in the classroom, this would be a 3-month to a 6-month conversation. However, because I know that the majority of you guys are actually in a position whereby you need to manage your day-to-day operations of your small business, I compress everything to try to get you the maximum amount of information in the allotted time. So let's talk about, quote unquote, the sole proprietorship, the easiest one, right? Who is it set up for? Well, quite frankly, it's just anybody that's literally a freelancer. Right? Is literally a freelancer. They're really simple to set up. Here's the problem with, quote unquote, operating as a sole proprietorship, though. You are personally liable for all the business debts. Okay, you're personally liable for all the business debts. Now, there are some quote unquote business structures whereby you are not, quote unquote, liable, but there's a hiccup to that. There's a caveat to that. Once I get to the limited liability companies and the C corporations, which in most cases, what social media tells you, hey, get one of these, and guess what? You're not liable. Well, yes and no. I'm going to go ahead and demystify some of those quote unquote TikTok videos right now. Okay. Now, again, as far as easy to set up, completely simple. I wake up one day, I say, hey, I want to get into business. Now, what is a demand of me? The only thing that's going to be required of you is literally to get a business tax certificate, which is a business license. You're going to get it from the city that you're operating out of. When it actually comes time to report your taxes, okay, now for these, taxes are due April 15th, okay, taxes are due April 15th. Now you're going to be reporting it basically on your personal income tax. Why? Because it's considered a pass-through entity, and it basically means that it's going to flow through your social security number. So when you complete, or should I say, when you file your individual taxes, okay, you're going to fill out a portion called the Schedule C on the Form 1040, which is nothing more than the profit and loss of the business. And then when you do that, you're literally telling the IRS how much money the business made as far as the sale and revenue is concerned, what were the expenses, quote unquote, and then what the net profit was. At the end, here shortly, when I start doing the quote unquote side-by-side comparisons, I'm going to show you how basically you legally pay yourself when you have this kind of a structure. Please understand that with this kind of structure, if you are the owner, you cannot be an employee of your business. Let me restate that. You cannot be an employee of your business. It's impossible. It's illegal, is basically what it boils down to. I'm going to show you what that means here shortly, guys. Just please stay with me. So again, as far as opening one up, we wake up. I want to start something. I have a business plan because I went through PCR. They created one for me. It allowed me to go ahead to increase the likelihood of success, because what do we always say? Fail to plan, plan to fail. Okay, fail to plan, plan to fail. So if we have a business plan, we start our business, we get quote unquote the business license, also known as the business tax certificate from our city, we're in business. Okay, we are in business. Now, one step above that is what they call the fictitious business name. You are going to be operating under a DBA, okay, doing business as. Now, it is literally the same thing as a sole proprietorship. The only difference is that when we open one of these up, we have to go ahead and attain, well, first and foremost, we have to file a fictitious business statement with the county, and then we have to attain an EIN number from the IRS. Now, much like the sole proprietorship, guess what? It is still going to be ran through your social security number, even though I quote unquote have an EIN number. Now, big question is, well, Chevy, I got an EIN number. Why is it still running through my social security number? Because it's a pass-through entity and because the IRS says so. The EIN is only if you have employees of the future, but you actually need it for other causes. I'm going to go over that here shortly as to why it's encouraged that we get an EIN once we actually start operating as under a fictitious business name and above. Partnerships. I love partnerships. Sometimes, not all the times. Why? Because it's shared risk. You have two individuals, okay? You have two individuals that basically want to get together because they have a diverse skill set. And what they want to do is go ahead and get into a business to make a little bit of money. Well, there's pros and cons to everything. What's that pro? Or should I say, what's the con? It's shared risk, right? What's the pro? We have shared resources. So we can actually take two entities, two people, a person and an entity, whatever the case may be, and set up a partnership. Now, to set up a partnership, okay, it's a little bit more involved. Not only do you have to file the fictitious business name with the county, okay, we also have to go ahead, get an EIN number from the IRS. Okay, the more important part though, all right, here's tip number one. Okay, here's tip number one that most people do not do. We got to set up a partnership agreement. Now, what is a partnership agreement? Well, it's a document. It doesn't get filed anywhere. It actually stays within the business profile, or should I say the business document. So there's no public record on this one. Why is it so critical? Well, at the end of the day, think of it like this. It's a prenup. You are actually going to be joined at the hip, which some people would say married. And so if there's ever a dispute, okay, if there's ever a dispute and it goes through mitigation, arbitration, and or the court systems, first document they're going to ask for is the partnership agreement. What did you guys agree to? Now, in some cases, I'll give you an example as to why it's extremely critical. Other than you're going to need it if you're trying to access capital, as in a loan. You're going to need it if you're trying to get into government contracting. There's a number of other reasons why you need it, but the most important one is this hypothetically assume that somebody is in a partnership and they're 50% owner. Well, does that mean that if the business has a profit, it's going to follow the ownership percentages, as in 50% of the profits will go to me and 50% of the profits will go to somebody else? And or does the partnership agreement say something different, as in, well, wait a minute, I'm the one that's actually putting in more of the legwork. I'm the one running the day-to-day operations. So if that's the case, even though it's a 50-50 partnership, when it comes to the profit distribution, I want 70%, okay? Or I want 80% because I'm involved with the day-to-day operations. Scenario like that is going to be classified as a general partnership, which basically means that me, since I'm doing the day-to-day operations, I should be entitled to more of the profit distributions, but even beyond that, I'm also going to be more liable. Okay, I'm also going to be more liable. So again, the partnership agreement is going to go ahead and disclose all that type of information, to include the bigger one, decision making. Who can make decisions on behalf of the quote unquote organization? So the tip for you is this: if you're going to get into a partnership of any sort, try not to use a boilerplate cookie cutter type of partnership agreement. Reach out to somebody, and it's probably going to be a lawyer, okay, that's going to have to develop one for you, because at the end of the day, it has to be precise. You're not going to identify all the potential scenarios out there that can possibly go right or wrong, but you should have a legal expert take a look at it and or write it for you. That would actually make you feel good at the end of the day, saying, hey, if something went wrong, we have the partnership agreement to fall back on. Now, again, ownership, very flexible. With regards to taxation, it is also considered pass-through. So therefore, it's going to be running through your social security number. Now, here's the deal with the partnership agreements, with the partnerships. If you're in a partnership or you're thinking about going into a partnership, the deadline, the due date to file your partnership is quickly arising, March 15th. Okay, March 15th. So the biggest reason why they if you're in a partnership, they have you do it 1 month prior to filing your individual taxes is just that you have at least 1 month to gather all the documents to go ahead and do your individual taxes. So any kind of a partnership, to include multi-member LLCs, they're always going to be due on March 15th. Now, the limited liability company, my favorite. Okay, my favorite. Why do I want one of these? Well, quite frankly, okay, for asset protection. The sole proprietorship, the DBA, the partnership agreements, okay, they do not provide any kind of asset protection. What exactly does that mean then, and why should it be applicable to you? Well, when a client comes to me and says, hey, I want to open up a business. Great. Have you considered your structure? Well, I'm thinking about an LLC. Okay, please understand a couple of things. What is your net worth? Okay, that's where we start off. What is your net worth? What does that mean? Well, how much assets do you have personally owned? What are your liabilities? And then ultimately, what's the net worth, the difference between the two? If in fact we have a house, if we are part of a trust, we have some, high-end items, high-valued items, I would say, yeah, an asset or quote unquote an LLC is appropriate for you at this given point in time. If in fact we don't, you might be okay operating under a DBA. Now, does the LLC provide more professionalism? Of course it does. Okay, but it does come with a price tag, $800 per year. Okay, $800 per year. Now, in some scenarios, when you're a startup, that actually might be a little bit too much money. So that's why I say sometimes it's okay to operate under a DBA. So the LLC, it does come with a quote price tag, $800 per year. And it doesn't matter if you make money or not. Here's tip number 2 for you. If you opened up an LLC in the past and you didn't file or you didn't pay for the $800 per year, you might want to reach out to us so we can help you try to go ahead and resolve that scenario. Because in essence, in the background, let's hypothetically assume that you actually started it in, 2022. Well, that means that you owe $800 for 2023, 2024, and 2025. But it also means that you have interest accrued with those $800. But it gets a little bit worse, guys. Okay, so if you filed for an LLC and you never paid your $800, it might behoove of you to reach out to us so we can actually help you resolve that issue. Now, the bigger reason why we actually want the limited liability, because it will offer us with some tax flexibility. What exactly does that mean? Now, before I actually talk about that, let me put this out there, okay? A sole proprietorship, a DBA, okay? A single member LLC, all right? A partnership, all right? They all get taxed the same way. They all get taxed the same way. There is no tax savings, okay? I know that there's a lot of social media, quote unquote, videos out there that says, hey, open up an LLC, you'll save in taxes. I'm here to tell you that you will not. You will not save in taxes. They are all filed the same way. They all run through your social security number. They all have access to the same business deductions. The difference is that the LLC can actually elect to be, it can actually elect what they call S corporation. Okay, so basically it means we're telling the IRS we want to be taxed as an S corporation. So thereby, when we do that, it does afford us a lot of tax flexibility. Now, how do we set it up? Well, you got to file the articles of organization with, quote unquote, the Secretary of State. Keep in mind that once you file it, doesn't mean that you're active. It's going to take a couple of days for it to be active. So once it is active, you're going to get a letter from the quote unquote Secretary of State. It's going to tell you, it's going to ask you to do 2 things. Number 1, you have 75 days to elect if you want to be taxed as an S corporation. If you don't choose to be taxed as an S corporation, by default, you'll be considered a disregarded entity, which basically means it's going to flow through your social security number. Within 90 days, you got to upload your statement of information that basically tells the Secretary of State this is the person that owns the quote unquote business. Now, we're also going to have to get an EIN, just like all the other structures, right? But in this case, we're also going to need a quote unquote operating agreement. So we're going to have to develop an operating agreement. Please understand the significance of the operating agreement. Okay, it's much like the partnership agreement. Matter of fact, in most cases, they're about the same. Biggest reason why we need one, okay, because it will, quote unquote, it will show separation between the person and, quote unquote, the entity. So in essence, what we're saying is we are telling, in the eyes of the law, we are saying that we are 2 entities. And by that, we're saying that the owner is completely separated from the okay. It is said that the quote unquote LLC is going to afford us the corporate veil, which basically means that they cannot sue me personally. They can only sue the business. So we do need an operating agreement, and a lot of do-it-yourselfers that I personally deal with. Yes, they're go-getters. Yes, they set up their quote-unquote articles of organization, but that's where it stops. The process is a lot more lengthier. Now, ownership, it can be one individual, It can be two individuals. It could be an individual and an entity. It could be two entities. It really offers a lot of customization. Okay. Now, again, liability protection. Again, if in fact the business is sound, the LLC is sound, we do get the protection of the quote unquote corporate veil. So again, if the business gets sued, they can't sue you. And also, single member LLCs that are considered disregarded entity, it will flow through your social security number. Okay, it will flow through your social security number. Now, if you elected to go ahead and be taxed as an S corporation, then it's a little bit different, right? That means that your business taxes are not going to be due March 15th. By the way, single member LLC that's considered a disregarded entity, taxes are due April 15th when you file your individual taxes. If you elected S corporation, the quote unquote S corporations are due on quote unquote March 15th, and you're going to be utilizing Form 1120S. Okay. All right. Then the C corporation. Now, as far as the C corporation is concerned, this one allows us to quote unquote raise capital. So in essence, when you set one of these up, you elect a certain amount of shares. Those shares can be sold. And if you do sell them, the individual that buys them becomes a shareholder. In essence, they are part owner of the business. So if you're looking to try to raise some quote unquote equity financing, this is a way to do it. Now, please consider one thing though. If you get a C corporation and the goal is to try and raise capital by selling shares, please ask yourself, why should somebody want to invest in my business? In most cases, we want to actually have a proven business model whereby we've actually generated generated revenues. If it is still in the infant stages, it might be a little bit premature. Now, the problem with these kinds of entities, it is subject to what they call double taxation. Please keep in mind, though, that double taxation is applicable at the quote unquote federal level. For some strange reason, they never talk about the state level. And believe it or not, it's not just applicable, or it's not double taxation. It's actually triple taxation. And we're going to cover that here shortly. Now, as far as compliance is concerned, it's a lot more complex than your regular LLC. There's other elements that go into play because by default, when you open up a C corporation, now you are an employee of your business, which basically means that you have to file payroll taxes on a quarterly basis to the quote unquote EDD office, which is unemployment office, and to the federal government. So forms DE9, DE9Cs, forms 940, 941s, they have to be done. Okay, here's a tip for you. If you're utilizing some kind of accounting software like QuickBooks, something that I use, they will do all the filings for you. Okay, they will do all the filings for you. If you don't do the filings, this is what you can expect. Okay, and I know this from experience. So with regards to the unemployment office, what will happen is you'll actually get a letter after about a year of not filing these mandated quarterly reports, and it'll be a bill for $7,000. And you're going to scratch your head and say, where did this bill come from? Well, when you opened up that C corporation, and or when you actually just have employees in general and you don't do the quarterly filings, the EDD office is under the assumption that you have employees. And so therefore, there's requirements there. And so therefore, what they're going to do is send you out a letter that's standard for them. If you are in that boat, that letter will say you owe about $7,000 and then a bunch of interest, accrued interest. So there is no workaround to that. You just have to comply with these filings. And can you fix it? Of course you can fix it. All you got to do is just reach out to the EDD office, and they will actually help you to fill out the quarterly reports. And again, if you're in a situation like me that I don't like doing that, I'd rather work on my business as opposed to in my business, I just hire out. I have QuickBooks do all the filings for me. Now, as far as protection is concerned, much like the LLC, it does afford quote unquote liability protection. So therefore, the business gets sued. That means that you, the person, cannot be touched if the business is sound. Okay, if the business is sound. Just filing your articles of incorporation is not a sound business. I'm going to go over what a sound business looks like. So just please bear with me. Now, the S corporation, I said it earlier. It's not a business entity. It's an election. Okay, it is an election. I elect for my LLC to be taxed as an S corporation. I elect for my C corporation to be taxed as an S corporation. What does that mean? Well, basically, what you're saying to the IRS is, hey, now I would literally want to be an employee of my business, but at the same token, what I'm saying is I want to take a reasonable salary. Now, any monies that are left over are going to be called a dividend split, okay? A K1 distribution, basically. What does that mean? It means that the net profit, when you got revenues minus your expenses, what's left over is called your net profit. It means that that net profit now, because you elected to be an S corporation, is going to take two roads. One of them is going to be a reasonable salary. The other one is going to be a K1 distribution. Think of a K1 distribution as nothing more that the business wrote you personally a check for an amount of money. Now, the big question, here's tip number 4 for you. If you are an LLC and you do elect to be quote unquote an S corporation, and you do take, there's no, you have to take the K1 distribution because it's going to be taxed. It doesn't matter if you leave it in the business bank account, it will be taxed, okay? Here shortly, I'm going to show you how all that works because I actually have a couple of slides that say this is how it all works. Now, let's continue moving forward. Oh, by the way, any questions in the chat, China, before I continue?
Yes, we had. Can you hear me?
Yeah, I got you.
Okay, there's 2 questions in the chat. One was from Jennifer. Is the legal protection only if the elect S Corp or in general with an LLC?
No, it's in general with the LLC. So remember, the S corporation is a tax strategy. It is not a legal entity. So the LLC, so all your documents will always say LLC behind the name. So I'm going to use myself, the Jock LLC. Okay, JLC is my quote unquote the what is it? The name, it's the acronym that I use for my, it doesn't matter. The Jock LLC. Okay, all my documents will always say that. However, when I file my taxes, it's going to be as an S corporation. Same thing with a C corporation if you elected S corporation. It'll always say something along the lines of the Jock Incorporated, the Jock Inc., whatever the case may be. The default is always the state. Okay, the default is always state. So when it comes to the liability protection, it's either the LLC or the C corporation, which provides the liability protection. But since we're on that line, here's another tip. Okay, tip number 5. Yes, if you have an LLC and a C corporation, quote unquote, if the business incurs any debt, that debt will die with the business if it's dissolved. But there's a caveat to that. There's a caveat to that. If, for example, you went out and you got a loan, an SBA loan, a traditional loan, whatever kind of loan you got under the name of the SBA, the rule of thumb, okay, the rule of thumb is anything over $50,000, you have to provide a personal guarantee. I've actually seen it as low as $15,000. It just really depends on the organization, the lending institution that you are actually dealing with. So just because, quote unquote, you have an LLC and or a C corporation, you took on debt, and hypothetically, let's hope that you don't default. But if you did default, you made a personal guarantee. Okay. In addition to that, you collateralized the loan. So the bank is basically implementing 2 safety nets to encourage you to go ahead and pay back the debt, number 1, but number 2, lower the risk from their perspective. If I can get a collateral for the loan amount and I can get you to personally guarantee this loan, then guess what? I've lowered the risk. And a matter of fact, I'm going to give you another tip. Tip number 6. The lending institutions actually take it one step further. Now they're having you pull out a life insurance policies, especially if you're a sole prop, a DBA, single member LLC, multi-member LLC, and or a general partner. You will pull out a quote unquote life insurance policy, making the lending institution the beneficiary. Right? So a couple of tips for you guys, because again, there's a lot of misleading information out there. What we like to do is actually provide you with the most accurate and up-to-date information. So what was the second question, China?
The second question is from Cheryl. Do you have to file the operating agreement anywhere official?
No, you do not have to file the operating agreement. The operating agreement is something that's internal and only you can see it. However, if you go to try to apply for a small business loan, they're going to ask for a copy of the operating agreement. Excuse me. If you're going to go into government contracting, during the process, they're going to ask for the operating agreement. So if you have an LLC, it's an operating agreement. If you have a multi-member LLC, which is two individuals, sometimes they call it an operating agreement, sometimes they call it a partnership agreement. If you have a corporation, okay, the equivalent of an operating agreement is the bylaws, okay, the bylaws. All right. Any other questions, China?
Nope, that's it.
All right, so let's move forward, guys. The employee identification number, the EIN. Okay, think of it as a social security number for the business. Now, what I'm diving into now was I'm actually doing the deep dive into as to why we need an EIN number, number one, but number two, what's the significance of it? So it's literally a 9-digit number. Think of it as a social security number of the business, right? So in essence, when you open up a small business, you want the EIN number for a number of reasons. Now, here are the always and sometimes, okay? If in fact, when do you need an EIN number? Well, if you're in a corporation or partnership, you always need an EIN number. If you're a multi-member LLC, which is nothing more than a glorified partnership, you always need a quote-unquote EIN number. If you have employees that are W-2, you always need an EIN number. If you have contractors, independent contractors associated with your small business, you will need an EIN number. So now that I'm on the contractors 1099s, here's tip number 7 for you. Okay, here's tip number 7 for you. Should you hire an independent contractor, one of the first things you're going to do from that independent contractor is request a W-9 from them. You want to capture their pertinent information, their name, their social security number. Now, why is that so important? Well, because from the perspective of a business, that is considered a quote unquote business expense. Okay, it is considered business expense. I hired an independent contractor. I'll give you the example for myself. Last year during the holidays, I actually hired somebody to help me out with some of my administrative paperwork, but even beyond that, to set up some of my private consultation calls. And so I had to pay that individual. Well, if I don't pay that, if I didn't submit or if I didn't capture the W-9 and provide my quote unquote independent contractor with a 1099, it basically means that I am going to pay for the taxes that I paid that individual. So hypothetically speaking, if I remember correctly, I paid her like $10,000. But in essence, what I'm doing when I give the 1099 is, hey, IRS, I paid this person $10,000. So therefore, they are responsible for their own self-employment tax, okay, their own taxes. I rid myself of it. For my business, it is considered a business deduction, okay? So it's a business expense. So it's critical that we actually have an EIN number, especially, again, when we have W-2s and or 1099s. Now, if you're in a type of business that requires that you pay excess taxes, you do need one, okay? You do need an EIN number, and especially if you're going after a small business loan, a line of credit, anything that basically deals with trying to access some kind of capital, you will need an EIN number. All right. Now, once we get that EIN number, okay, let's transition forward a little bit. I need a business bank account. Now, why do I need one? Well, first and foremost, is there's a little term that we actually call commingling in the quote unquote finance world, or should I say the accounting world, or should I even say the IRS world? Okay, commingling. What does that mean? It means that I utilize one business account for both my business. I'm sorry, I use one account for both personal and business. That's a big no-no. Okay, that is a big no-no. That is considered commingling. And this is especially true for quote unquote LLCs and C corporations. You should never have a personal account. You should always have a business account. Now, when we do that, there's clear separation now between quote unquote the person and the business by having actually two accounts. Now, when we open up that account, however, we got to fund the business, guys. We have to fund the business. What does that mean? It means that you got to have some capital injection into it. You have to put some skin in the game. You have to fund the business. Why is this critical? Quite frankly, because now you have a budget. Okay, you will create something called a day one balance sheet. right? And the quote unquote CPAs love day one balance sheet. People that read financial statements loves the quote unquote balance sheet. I love the balance sheet. It gives me more information than the profit and loss statement does. But the goal to the idea here is to fund the business. If I put $1,000 into the business, that's what I have now in order to pay for the expenses associated with my business. I am not tapping into my personal quote unquote accounts. Okay. I'm separating everything, business and person. Now, while you're at the bank, I would actually ask you to go ahead and open up a business credit card. Now, here's another tip for you. Tip number 8. If in fact, okay, your credit scores are low. Now, what's considered low nowadays? Anything under a 640 is considered low. Some of the banks, some of the lending institutions will say, no, you can't get a business credit card because it's too low, but you can ask them for what they call a secured credit card, which basically means that you are going to be providing some kind of funds to secure the credit card, and the limitations are going to be whatever you put down. $1,000, $2,000, that's going to be your credit limit. In about 6 months, you're going to ask the bank to go ahead and pull that secured credit card and then literally open up an unsecured credit card. So the goal is to build a business profile. The goal is to go ahead and start building business credit. Why? Because when it actually comes to the loan process, they're going to want to see good trends from you. All right. So got to have a business bank account. And then the last one is what, again, the business tax certificate. So got to go ahead and transition, quote unquote, or should I say get authorization from the city that you're operating on. Now, there are some cities that, quote unquote, don't actually have their own municipalities. And I'm going to pick on good old East LA, where I grew up at, to say, well, they are considered a, what are they considered? I'm forgetting over here. They're unincorporated is a key word. They're unincorporated, so therefore they don't have a municipality. So therefore, depending on where you live, you might have to get your business license from LA City and or the county. But the point is, you need to have some kind of certification that allows or provides you with the authority to operate out of that jurisdiction. Now, I always say that a sound business structure is going to go look like this. I have my quote unquote business entity filings. I'm going to pick on the LLC because there was a couple of people on this on this webinar, about 3 if I remember correctly, it says they have LLC. So basically, this is what you're saying. You have your articles of organization, you have your EIN letter, and you have your operating agreement. If we have those 3 things, then guess, quote unquote, we are actually have a sound business structure, at least for the business entity. We got an EIN number. Why? Because in order to get an EIN number, we needed to open up a business bank account. And if we open up a business bank account, then all we got to do now is get our business license, and then ultimately we got to get some business insurance. Okay, we got to get some business insurance. So, ladies and gentlemen, that's literally what a sound business structure would look like. Now, let's get into the bulk of this. Okay, let's get into the bulk of this. What you're here for. Do I have the appropriate structure? Well, by now you should start to gather if in fact you're in the good structure or not. All right. So let's talk about quote unquote deductions. Okay, business deduction. So there's 2 ways that I can argue to say something can be a business deduction. Okay, the one that I like to use is an individual that I used to listen to, which from time to time I still do. Les Brown. He's a motivational speaker on YouTube. And what he used to say is, if I got to spend money to make money, it can be considered a business expense. Now, the key word is can. Now, let me tell you what the IRS says. The IRS says is that an expense has to be ordinary and necessary for the business to function. 3 words, ordinary, necessary for the business to function. So basically what they're saying is that without this quote unquote expense, the business is not going to be able to function. Right? The business is not going to be able to generate any kind of a profit. So therefore, let's talk about some of these expenses that are out there that a lot of times we just forget about. Advertisement. If you have to go ahead and pay for some kind of monies to promote your business, the entire cost of that is 100% tax deductible, which basically means that I can take my top line, which is my revenue, subtract that expense, and then the remainder is going to be my net profit. So these are all expenses, guys, deductions, okay? Insurance, depending on your structure. For right now, we're just talking about pass-through entities, okay? Pass-through entities with the exception of the S corporation. So the cost of business insurance is tax deductible. The cost of health insurance for yourself is not. Okay. Legal and professional services. Well, if I got to hire a lawyer, if I got to hire an accountant, if I got to hire somebody that's going to help me save on taxes, that is considered a professional, 100% tax deductible. Business expenses. If I got to go ahead and purchase items for my small business, for example, when I started out my small business and I funded it with about $3,500. So I took my personal money, I put it into my business bank account, and from that point forward, that was literally my budget. So for the better part of about a year, almost a year and a half, I did a lot of pro bono work and very few revenue that I generated. But the goal was to build my clientele, which I did. But the point is this, though. I wrote off everything. I bought a desk. It was necessary. It was ordinary and necessary for me because of my home office. I bought computers. Ordinary and necessary. I bought HDMI equipment that I use right now. I'm utilizing it. Okay. Ordinary and necessary. My subscriptions, ordinary and necessary. Anything that I have to, that I pay for right now that is considered quote unquote ordinary and necessary and I need it to function, I write off as a business deduction. So cost of paper, pens, you name it, if it's office related, I write it off, and I have written it off in the past. Taxes and licenses. This can include quote unquote sales tax, property taxes, permits, ordinary and necessary of the business. It can be quote unquote a business deduction. Now, this is where it gets a little bit hairy, this next group, okay? Most of us do not know that, in fact, we can write off certain items with our small business. Right? I'm going to focus on the home office right now because the home office is literally the starting point for these other quote unquote deductions. Okay. This is what the IRS says about the home office, or should I say the home office expense. There's two categories. There's what they call the simplified method, which basically means that you have to have a quote unquote dedicated space to conduct quote unquote your day-to-day operations. I'll use myself as an example. I have a dedicated space. It's about 200 square feet. It is a room that I built. Within my room, I have literally everything that I need. Okay. Because I have a dedicated space, I qualify for the home office. Okay. Now, what the law says is you can actually deduct, or should I say you have an ability to deduct $5 per square foot up to 300 square feet. So in my case, I take it's only 200 square feet. So when I multiply the 200 by 5, I get about $1,000 deduction, or should I say business expense against my business. So I am actually taking that deduction. Now, there's what they call the actual method as well. Okay, the actual method basically says, well, your home, which includes quote unquote, your part of your mortgage and or rent. It can include the utilities, basically the day-to-day expenses to maintain a home. You can take a percentage of it, and that percentage is going to go ahead and align with the square footage of the area that you occupy. So in my case, my home is 1,800 square feet. It's not a big home. If I wanted to take the actual method and I actually did the crunch the numbers, it might be more than $1,000 that I actually get as far as the deduction. However, it requires a lot more documentation. Receipts. Okay, receipts. I'd rather do the easy route and take the home office. Okay, but please understand that the home office is going to be the starting point for many other ones, the other three that are listed up here. If I got to travel somewhere, okay, so if I got to, let's hypothetically assume that I'm going to travel to, I don't know, Las Vegas, then I got to meet a client. And the key word is meet a client, so I can actually have or discuss, quote unquote, business needs of the clients. I can write off my transportation and lodging. That's 100%. If I met with that client to eat a meal, it gets a little bit tricky. Sometimes it's 100%, but in most cases, it's only 50% deduction. Now, the mileage is the one that I really, really like to harp on. Okay, the mileage is the big one right here. Most of us don't know that we actually have an opportunity to write off the mileage to and from. The starting point is always going to be the home. So if I had to travel, let's say that I'm in the San Gabriel Valley and I had to travel all the way down to, I don't know, Mission Valley to meet a client, and I do have clients down there. Well, that's about 100 miles one way. So that's a 200-mile, quote unquote, to and from. I can write off 0.72 miles for every mile that I actually drive. Now, the key to that, though, however, is I got to maintain detailed records. The date, who I met with, what we discussed. Okay. If I do that, then quote unquote, I can claim the mileage. Now, there are some people that get overly aggressive with mileage. Please try not to do that. Okay. Please try not to do that. Basically, what you're asking for is to get audited, and that's not the one thing that you want to do. Now, in most cases, if you do get audited, don't be afraid. Please do not be afraid. The worst they can do is say, hey, you owe me a couple of dollars and you just have to pay it. You're not going to go to jail because you're not a big fish, as in you're not a Martha Stewart, a Wesley Snipes, and Al Capone. You know, somebody that actually, quote unquote, did a lot of tax evasion with a lot of money. We're small fish in a big pond. Matter of fact, in most cases, if you do get audited, they're not really gonna dig that deep. Okay, but how do we actually go ahead and avoid getting audited? Be honest. That's how you avoid it. Be honest and keep your receipts. Okay, keep your receipts, because ultimately, if you do get audited, what they're going to want to see is receipts. And no, bank statements will not go ahead and justify an expense. They want a bona fide receipt.
Question in the chat from Jonathan. How far back can you deduct business expense? He said, for example, he purchased a computer in October of 2025 and registered LLC in February of this year.
Okay, so you got two issues right there. So you technically you try to do a startup in 2025 as a sole proprietor, which ultimately you can claim that. But here's the problem with that, though. Did you generate any money? Now, I'm going to use some hypothetical numbers. If, in fact, let's say that with your startup in 2025, let's say that you spent, I don't know, $3,000, okay, just to get your computers, desks, printers, whatever the case may be, okay, but you generated $0. Okay, you generated $0. Well, here's the problem with that. Can you write off the startup expenses? Yes, you can. When you file your taxes for 2025, you can go ahead and claim those losses, but it's going to be limited because you generated $0. Okay. Now, if you actually were to have generated some kind of revenue, you can write off the entire thing the first year. Okay, you can write off the entire thing. Now, the IRS doesn't define what a sale is, but you can read between the lines on that one. 2026 going forward, well, you can say that you bought it in 2026, but you really bought it in 2025. So the quote unquote, the appropriate answer is you can still write it off for 2025. It just means that the amount that you're going to be able to write off is going to be limited. And normally for startup, it's about $5,000. So in your case, if you spent $3,000, you can write off the entire $3,000. But if you came back and says, no, Chevy, I spent $23,000 for my startup, but I didn't generate any revenue. Well, you're going to be limited to $5,000 for that first year. And then the remainder is going to be amortized over the next 15 years. And given, of course, that there's no equipment associated with it, as in there's no Mackers, as in there's no depreciated, quote unquote, or should I say asset depreciation. Okay, this is just an overview. So can you write it? Can you go ahead and write off stuff in 2025? Of course you can. That just means that when you file your taxes in April of 2026, you basically said, I started this business. I bought these items. Here are my receipts. And it's unfortunate I didn't generate, or maybe you did generate money, right? So I think you get the concept. So hopefully that answers your question, my friend. Sometimes I get a little bit overdrawn, but it's pretty simple. It's pretty simple. The answer is yes, you can still write it off. All right.
We have one more question too. Before we move forward, from Derek, how do you keep receipts for business travel to a client or potential client's location?
Well, you can snap them. QuickBooks actually allows you to go ahead and snap that receipts and then upload it into the system already, so it's there forever. And or you can do what I do. I do that. Plus, I actually keep the hard copy receipt and I hate to say this, in a Ziploc bag that I actually have in my safe. So I try to separate everything. I always try to have a backup to a backup. Any other questions?
No, that's all.
All right. Let's go on to what they call QBID, qualified business income deduction. Now, what is this? Well, if you're familiar with the taxation, on the personal side of the house, everybody has what they call a standard deduction. What does that mean? It means that the federal government allows you to keep some of the monies without being taxed. If, for example, you are single, okay? If, for example, you are single and you are filing as single when you do your taxes for 2025, you get a standard deduction of 15,750. What does that mean? It basically means that if you actually made $100,000 in W-2s and 1099s, the first $15,750 are not going to be taxable. Now, how does that align with QBID? Well, the 45th president of the United States back in 2017 created this thing called QBID, Qualified Business Income Deduction, which basically equates to a standard deduction just for the business. At the time, it was only 20%. So basically saying that the net 20% of your net profits would not be taxed. It'd be free and clear. It's for you to keep. Now, July 5th, 2025, they upped the ante to 23%. Okay, so basically QBID, Qualified Business Income Deduction, is a way to stimulate the economy by allowing you to keep more money into your pocket. Now, how does this all work? Well, let's take a gander here. Okay, let's take a gander. So let's hypothetically assume, okay, that your small business generated $125,000. Now, I am going to speak from the perspective of operating as a sole proprietor under a DBA and or a single member LLC that's considered a disregarded entity. As in, there's no S corporation or corporation involvement here. It's all the other ones, okay? So hypothetically speaking, the business generated $125,000, but it had to spend $55,000 for the day-to-day operations, okay? What's left over is what we call the net profit, okay? That net profit represents how you legally paid yourself, okay? Let me restate that. This is how you legally paid yourself. In the eyes of the IRS, $70,000 represents, quote unquote, your salary. So what does that mean to you? It basically means that that $70,000 is going to be subject to something called self-employment tax. If you are employed right now and you take a look at your check stub, on there you're going to see some deductions, okay? For Social Security and Medicare. They call it FICA, F-I-C-A. When you're self-employed, they call it SECA, okay, S-E-C-A. There is no difference, though, with the amount of money that you're going to get taxed. It's going to be 15.3%. When you work for somebody else, okay, you pay half. You personally pay half of the 15.3% because a combination of Social Security and Medicare, we're going to pay 20. Well, the requirement is that the employee plus the employer pay 12.4% Social Security of the net profit, 2.9% for a combination of 15.3%. So both Social Security and Medicare, we have to pay 15.3% into it. Now, if you were employed, if you were a W-2 employee of somebody else, they would pay half, the employer would pay half, and then you, the employee, would pay the other half. But because you are an entrepreneur, you are paying both the employer and the employee portion, 15.3%. In this equation, what we're saying is that the $70,000 is going to be subject to the 15.3%, which means that you're going to pay about $10,710 into quote unquote self-employment tax. You cannot get away from that. The only way that you're not going to pay into Social Security and or Medicare is if the business is operating at a loss, which basically means no net profit. Now, what it's also saying is that now, because it's a pass-through entity, QBID, okay, QBID is going to be a factor, the qualified business income deduction. Well, what are we saying now? Well, that 23% of that $70,000 net profit is not going to be taxable. So in this case, about $16,100. The difference is about $53,900. Now, what does that mean to you then? Okay, well, in essence, what we're saying is this. If this was your only source of income, okay, if this was your only source of income, when you filed your quote unquote taxes, okay, 53,900 would represent what would be subject to federal and state. Now, the individual tax rate is a quote unquote tiered, as in a portion of that money will be taxed at 10%, a portion of the additional monies will actually be taxed at 12%. As a matter of fact, give me a second here and I'll tell you what those rates are. So the first quote unquote, if you're filing single, up to 11,925 would be taxed at 10%. The remainder between 11,926 and 48,475 would be taxed at 12%. And if you make more than $48,000, between 48,476 and $103,350 would be taxed at 22%. And it just goes higher, higher, and higher. So it's 10%, 12%, 22%, 24%, 32%, 35%, and then 37%. So I use 18% because the majority of the small business owners that I deal with are at that quote unquote average. The average being 10%, 12%, and 22%. Okay, so on average, federal income, we're going to pay about 18%. State income, about 7%, right? About 7%. So the point being is that, in by the way, okay, again, this doesn't constitute any quote unquote legal advice, or should I say tax advice. Please consider that I'm not even included the standard deductions in here, okay? it's a broad overview so you understand how the taxation system actually works. But the bottom line is, even though the business made $125,000 and this was your only source of income, you would really just be walking away with about $44,688. Okay, again, this is for illustration purposes only. But as you can see, there's a lot of taxes that go into having a small business. Okay, 15.3% with quote unquote self-employment tax. Right, if you can add it up right now, you got about 15.3% for self-employment tax. You got about 18% at the federal level and about 7% at the state level. Okay, so it does add up to about 40%. We open up small business to pay about 40%. And even if you had a quote unquote W-2 job, you work for somebody else, it wouldn't be up to the 40%. It'll probably be at about 33%, 30 to 33%. Because remember, self-employment tax, half is going to be paid by the employer, and then you are going to pay the other half. All right. Any questions on this anywhere, China? All right, let's move forward then. The S corporation. Okay, the S corporation. Well, here's the beauty about the S corporation. It may qualify for the QBI, qualified business income deduction. There is a caveat to that, though. Even though the S corporation is considered a pass-through entity, you have to actively participate in the business in order for QBI to qualify. Now, sometimes, or should I say, the greatest example that I can use is real estate. Okay, real estate. If in fact you are renting out a home and it's considered long-term, and you are not a real estate professional and you do not meet material participation, you are not active in the business. So therefore, okay, QBI, you're not going to qualify for QBI. Now with the S corporation, remember what I said, we have to take a quote unquote reasonable salary, right? So, but at the same token, now we can actually do what they call employee benefits because we have an S corporation. Let's take a look and see how that looks now as far as taxes is concerned. All right. Now, here is a business, side-by-side comparison. It's the same business. It's a single-member LLC. The only thing is that we elected to be taxed as an S corporation. So basically what we told the IRS is, hey, I want to be taxed as an S corporation. Great. So take a look, okay? Same thing, numbers. Still made $125,000 when I compare the two. I still have $55,000 when I compare the two. And I still had a net profit of about $70,000 when I compare the two. So what's the difference? Why all the hoopla? Well, because when you open up an S corporation, this is where you start saving on taxes, specifically what they call self-employment tax. Now, if I took, because remember, as an S corporation, I have to take a reasonable salary. So now I have two avenues that I have to consider. One of them, the reasonable salary, whereby I become a W-2 employee of my business. And then the other one is going to be what they call a K1 distribution. Remember what I said about K1 distribution? It basically means that the business wrote you a check on paper. And so therefore, when you pay taxes on that check or on that money, it's going to be through the individual tax rates. Okay. So because I took a reasonable salary, in this case, about $28,000, in essence, what I'm saying this, my 15.3%, the $28,000 is now going to be subject to the 15.3% of self-employment tax, which basically means that instead of paying taxes now at the quote unquote for Social Security, it went from about 8,680 down to about 3,472. For Medicare, it went from 2,030 down to 812. And then overall, it went from 10,710 to about 4,284 for a tax savings of about $6,426. I just saved myself $6,426 simply by telling the IRS, filling out the appropriate documents to say, I want to be taxed as an S corporation. Okay. Now, QBIT, qualified business income deduction. Guess what? That's still applicable because you are participating in this business. So the 23% is only going to be applicable to the 42,000, not the 28,000, because the 28,000 in essence is a business deduction of the business. So earlier I said as a sole prop, okay, as a DBA, as a single member LLC, as a multi-member LLC, as a partnership, you cannot be a W-2 employee of your business. Impossible. Why? Because if you were, it'd be considered a business deduction. It can't be a business deduction. You have to be some kind of a corporation if you're the owner. Now that we have an S corporation, the owner can be a quote unquote W-2 employee of the business. So therefore, it is going to be considered a business deduction of a business. Okay. So the net profit theoretically now is going to be that $42,000. So when we start thinking about QBIT, what we are saying now is that what's going to be applicable to QBIT is only the $42,000. So 23% of the $42,000 is not going to be taxable, which is about another savings of about $9,660. The remainder, should I say not the remainder, but the reasonable compensation plus, and the reasonable compensation over here is the $28,000 plus the QBI, which is a qualified business income, is going to add up to about $60,000. So what we're saying is that the $60,000 now is going to be quote unquote subject to the federal taxes and the state taxes. Okay. Again, please keep in mind, okay, when it comes to federal and state, right, the business is not paying for federal and state. The person is paying for it. I use this for illustration purposes only to showcase that if this was your only source of income, you would be required to still pay federal and state taxes on the individual side of the house. All right. China, any questions?
No questions.
Okay, so let's move forward then. This is why I really love the S corporation, guys. Okay, because now my S corporation can actually set me up for generational wealth, for success. What do I mean by that? I pulled out a retirement plan. Okay, I personally have a retirement plan underneath my small business. Matter of fact, the consultation I had this morning with a private client, we discussed that. Okay. This is what it means, okay, for you. If you have an S corporation and you decided to open up a retirement plan, but even on top of that, as an S corporation now, and or even a C corporation, the business can pay for health insurance for the person, and it can contribute to retirement plans, and it will be considered business deductions of the business. So in this case, it's the same corporation, it's the S corporation. The only difference now is that the business is paying for health benefits and also contributing to a retirement plan. Okay. So again, it's the same thing. Health benefits, it costs us $10,000 to keep the employee happy. And we were able to contribute $7,000 to the pension. Why $7,000? Because with the IRS, in this case right here, because it is considered a solo 401k. If you have a solo 401k retirement plan, 25% of your quote unquote reasonable salary can be utilized, or should I say, 25% can be the business can contribute to your retirement plan. So in this case, 25% of $28,000 to $7,000, right? If the individual was getting paid $100,000 as a reasonable salary, that means that the pension contribution can be up to $25,000, right? So here again, what we're saying is, hey, we can contribute to health benefits and a pension plan. Why? Because I need health insurance. That's why. And even beyond that, I'm trying to build retirement accounts. So having said that, again, we're still taking a $28,000 quote unquote reasonable salary. We're still only paying $4,284 when I do the side-by-side comparison. The only difference is that, again, the business is paying for my health insurance, and the business is also paying for quote unquote my retirement. And so therefore, I still qualify for my qualified business income deduction. In this case, I don't have to pay taxes on $5,750. What I do have to pay taxes on is a remainder of $47,250. Okay, $47,250. Now, what I like about this scenario right here is this is the way I interpret it. My business now, even though it only made it made $125,000, right? It had $55,000 of expenses. It paid for my insurance plan, personal insurance plan, but it also contributed to my quote unquote retirement fund. And even though it might look like total taxes paid, and even then total taxes paid when you do the side-by-side comparison, regular S corporation without actually the benefits is a little bit higher than with the benefits. So there are strategies, and I just pointed them out to you, whereby you can contribute to retirement plans. You can get health insurance for yourself and still pay less in taxes. And you're still generating generational wealth. Why? Because it's a retirement plan. Now, here's tip number 8 for you. If you're not in this position just yet, okay, I would have you to do this. There are individual retirement accounts that are out there, and they're either sponsored by the bank that you're with and or some kind of a brokerage company, whether it be Schwab or Fidelity. There's 2 types of IRAs, traditional and Roth. Those are individual retirement accounts. What the law says is as long as you have ordinary income, you can contribute to them, but it's going to be limited to that ordinary income. So this is what I mean by that. In 2026, if I remember correctly, and let me take a look at my little book right now. In 2026, or should I say, I'm going to pick on 2025 because some of us haven't filed our taxes. If you contributed to a traditional IRA, and you're under the age of 50, you can contribute up to $7,000 into that traditional IRA, which basically means this for you. You are going to be able to lower your taxable bracket by $7,000 and or whatever you contributed. The max is $7,000 for 2025. Okay, the max is $7,000 for 2025. Now, if you're over the age of 50, it's up to $8,000. But in essence, if I was in a predicament where I didn't have a retirement plan for my small business, but I still wanted to contribute to some kind of a retirement plan, I would contribute to my individual IRA. And depending on my tax scenario, I would either contribute to a traditional and or quote unquote a Roth. The combination of both the traditional and the Roth, cannot surpass the $7,000. Now, depending on your tax scenario, when you talk to your CPA, sometimes they advise that it'd be best if you put it in the traditional, and then sometimes they advise it'd be best that if you put it in the Roth. Now, the Roth will not lower your tax liability, but it will grow tax-free. Okay, it will grow tax-free. All right, any questions on this?
No task, just a time warning. We have 8 more minutes. So we just got a question in from Jennifer. Can you have a solo 401k that business contributes to and a personal IRA for your income contributions as individual?
Now you're starting to think like a tax strategist like myself. Yes, you can. Yes, you can. Okay, you can max them both out if you desire to. With the solo 401k, depending on how you're structured, it's up to $24,000, $24,500 that you can actually utilize to reduce against your adjusted gross income, and then even your traditional IRA. They do not quote unquote coincide with one another, so you can actually max both of them out. Great question. All right, so then the last one, C corporations. Excuse me. Problem with the C corporation is that there's no QBI deduction, right? But you can go ahead, and it's very much like the S corporation. You can have deduct the employee salaries, the health benefits, and quote unquote the retirement contributions. This is literally what a side-by-side comparison of an S corporation and a C corporation would look like. What's the difference? It's just that the C corporation elected to be taxed as an S corporation. Now, again, same thing. Business made 125K. Expenses were 55K. Health benefits, both of them paid into it $10,000. Both of them contributed to $7,000. Now, the big difference between the two is at the bottom. Okay, S corporation will qualify for the QBID if, in fact, you are participating in the business. However, for a C corporation, it's not applicable. S corporation does not have to pay the corporate tax rate and doesn't have to pay the capital gains. Those are at the federal level. What they don't tell you about is a California corporate tax rate, which is another 8.84%. When you do the side-by-side comparison, what you would take notice at the bottom line is that total taxes paid for an S corporation is about $16,000. For a C corporation, it's about $12,000. Please keep this in mind, though. Okay, just because this illustration showcases that the C corporation is going to pay less in taxes doesn't mean that it's always going to be that way. The more money, the more revenue that you generate, the more that you're going to pay in taxes, guys. It's just for this illustration, it looks like the C corporation is going to save more in taxes. In most cases, it's always going to be the S corporation that pays less in taxes. And the biggest reason is these three culprits right here: the corporate tax rate, the California corporate tax rate, and the capital gains. That's where you're going to pay the most of your taxes when you are set up as a C corporation. So again, the more money you make, the higher that corporate tax is going to be, the higher the California corporate tax is going to be, and the higher the capital gains is going to be. Ladies and gentlemen, that's pretty much it. That's the end of the presentation. I try to keep it as short and sweet as possible today, and so try to understand that we have limited time. But before we depart, I want you to ask yourself a couple of questions. What's your business goals? Are you into a hobby? Or are you trying to convert that hobby into something that's going to be quote unquote profitable? Which, quite frankly, profitability means nothing in my world. Okay, cash flow means everything in my world because profit doesn't pay my bills. Cash pays my bills, which is the same attitude and mindset that you need to start understanding now. As far as growth plans are concerned, you need to evaluate your structure. Okay, is it optimizing me? Do I actually save on taxes? Am I cash flow positive more than I am quote unquote profitable? Risk tolerance. It's all about risk. In some cases, when you start dealing with retirement plans, you got to understand how much risk you're willing to take. And then ultimately your tax implications. The conversation that I had this morning with this young lady was phenomenal in the sense that she's in a predicament now where she's starting to understand that the more money you make, the more problems you have. And in her case, it's the IRS. She's paying more and more in taxes, which basically means that she's going to have to get a tax strategist to go ahead and show her how to reduce her tax liability. All right, guys, that's pretty much the end of my presentation. I truly appreciate you being with me. I don't know how much time we have left. However, if there is a quote unquote question, please come out, ask me, and then I can address it. And then at least for the last 30 seconds to a minute, I would like to give the microphone back to our host and then just thank her for her, allowing me to go ahead and present and allowing PCR to partner with the LA Library once again. Any questions by anybody?
Where can I access the recording? Lizette is going to provide us with the recording, so we'll send it out to all those that were in attendance today. So just be on the lookout for that from our team. Yes. So Miss Jazz, if you want to connect with Dr. Chevy or any of our other business advisors that are on our team, I'm going to drop in our email So if you can grab that, it's info at pcrsbdc.org.
Oh,
And I'm going to drop that in the chat.
yes. So I just wanted to
Sorry.
repeat.
Sorry, Mr. Jazz. Sorry about that.
So I also wanted to repeat that. Yes. So once I end the live stream, it will record, and then I will send the link immediately to your to China and the group, so that way you guys have it, and it's available for you right away. It will also be recorded. It would also be on the library's YouTube channel. So if any of you want to go back to see any of the library's previously recorded programs that we have saved, you can also check those out as well. So that's also that's also the case. And we also had someone from the public, Dr. Chevy, who also said that this was awesome. They said thank you. They were also, I guess, when you had asked the question as to what companies they were into, they had said that they were a C corp and a nonprofit. So that was their thing. So I'm assuming that the same sort of strategies apply for a nonprofit as to some of the issues that you mentioned earlier throughout your presentation, or maybe not. I may be assuming.
Okay.
And then let's see what else. So yes, so Mr. Let's see, here we go. Mr. Jazz says thank you as well. So this was a great presentation. I agree, totally agree. I myself learned a lot. Although I do have a question. Just quickly, and I was really curious about this. So when you mentioned that, there's an echo on my end. I hope that's not. So when you mentioned the EDD one, the $7,000,
Mhm.
does it doesn't? Do they know how many employees, or does it matter, or is it just a $7,000 fine that they send you?
It's just a standard letter to get your attention, and trust me, it gets your attention.
Oh my God.
It's basically saying, hey, by the way, you failed to file these reports on time, so therefore we're going to capture your attention. And so, can you rectify? Yeah, it's real quickly to rectify. You just contact them, and believe it or not, they're super friendly.
Oh, okay.
They will actually walk you through the process. Say, all you got to do is update these reports, and then once you update these reports, you're fine.
Oh,
But
okay.
it is, trust me. When I got my first letter, I was like, oh Lord, what is this right here? It got my attention real quick.
Because I'm like, I mean, because getting a letter and with the $7,000, and you're like, what?
No, absolutely, absolutely. But no, it's something that we have to be mindful of when it's not as easy as just saying I'm gonna open up a business. No, there's a lot of compliance behind it.
Mhm.
So what
Yes,
I
and
like to do now is just I just farm it out. I don't, not to say I just don't want to deal with it. I'd rather pay somebody that's their profession to
yeah.
make sure that everything's done correctly.
Yes, and that's kind of like what we try to tell our patrons when they come here to the library, that it's easy to read things in the books,
Mhm.
but really forming and starting the businesses and all these different types of of different settings, it's a different kettle of fish.
Oh
There's
yeah.
a lot you have to do. There's a lot of work that you have to put into this.
Mhm.
And a lot of our patrons don't realize that. It's really simple and easy to say, hey, I just want to go and, grab something. Or like you say, you see it on TikTok, or you see it on, social media. But the reality is that there's a lot of work that you need to put in. And it's great that we have you here, and that the SBDC was willing to have you and to come and give us this great presentation to show our patrons that there is a lot of work that needs to be done, and that you really need to be serious about it when you open an S corp or a corporation or an LLC. So again, this will be recorded. Hopefully, you guys will take advantage of it. Yeah, sorry, I got distracted by what Jazz Patrick wrote. And and yeah, so take advantage of it. And we are beyond our time now. And I wanted to thank you, Dr. Chevy, again, and China and SBDC for this great presentation and for being here with us today. As I mentioned earlier, and I will repeat it again, this presentation is being recorded, and it will, once I end the live stream, it will be saved on the library's YouTube channel. I also want to remind everybody who joined us today that then part 2, which is self-employment and estimated tax payments staying on track all year, will be happening on Wednesday, April 1st at the same time at 11 a.m. So please join us. I believe it's in 2 weeks, if I'm not mistaken, for the next part of our series. It's going to be the same sort of format, live streamed on the library's YouTube channel. And if there aren't any other questions or concerns or comments, we will be heading on out. And for those of you who, no, nothing else, well then I will bid you all a great afternoon. Thank you for being with us. So
Thank you so much.
Thank
Bye,
you.
guys.
Bye. Bye, everyone. Thank you again.